How's everyone doing? Welcome to the Strategy Rooms. It's Saturday night, July 19th, 2025. So I hope everyone's having a great time out there tonight. We have a lot of great stuff to talk about tonight. We've got interest rates. We've got crypto bills that got passed. We've got inflation numbers for this week. We got tariff news. We've got Jeremy Powell under pressure at the Fed. So we have a whole plethora, a ton of stuff to go over tonight. I am going to kick us off as I usually do. We're going to take a look at our debt clock here and just see how we are doing so far. And again, no real surprises here. Still rolling over $37 trillion in national debt. Still rolling over a $2 trillion annual federal budget deficit. The Doge clock continues to roll up to about $562 billion in savings, now cracking over $5,000. Per taxpayer. So we're still hovering around 123% debt to GDP. So hopefully something someday, somehow will happen to start to reverse some of these numbers. But a lot of stories to get into tonight. Obviously, the big one of the week here I want to cover: Trump signs major crypto bill to set up stablecoin regulatory framework. This could be perhaps the greatest revolution in financial technology since the birth of the internet, the president said. And I don't think that's an understatement. So President Donald Trump signed a key piece of cryptocurrency legislation on July 18th, establishing the first significant U.S. regulatory framework for stablecoins. After a rocky beginning to Crypto Week, House Republicans successfully passed a trio of key crypto bills, including landmark stablecoin legislation. The Genius Act, fully named the Guiding and Establishing National Innovation for U.S. Stablecoins Act, passed 308 to 222 with bipartisan support. The Genius Act creates a clear and simple regulatory framework to establish and unleash the immense promise of dollar-backed stablecoins. Trump said at a White House event, "This could be perhaps the greatest revolution in financial technology since the birth of the internet." Trump had been a vocal supporter of the Genius Act, which establishes a regulatory framework for stablecoins by installing consumer safeguards, reserve requirement ratios, and audit and anti-money laundering standards. When the Genius Act encountered hurdles in Congress, the president intervened and urged a dozen dissenting GOP lawmakers to move ahead with a key procedural vote to advance the bill to the House floor. Crypto czar David Sachs, meanwhile, called it a historical legislative achievement that will serve as a monumental step to ensuring U.S. dominance in the industry. Sachs also estimated that stablecoins will create trillions of dollars in demand for U.S. Treasury securities, echoing the sentiment expressed by Treasury Secretary Scott Bessent. Stablecoins are backed by safe and liquid assets, such as the U.S. dollar and government bonds, and hold these assets in reserve for their coins. So I'm hoping that this is going to be really good. But we'll see. There could be some, well, I think this will be good for stablecoins, and it may end up being really good for U.S. Treasuries. Could be some side effects here. This could actually hurt banks. It could hurt banks from a depository standpoint. Now, before we get into the deposit thing here for a second, I just want to address a couple of things. So there were three crypto-related bills that got passed by the House here. So we had the Genius Act. Then we had the Clarity Act, which was H.R. 3633, and that was the market structure bill that would determine which crypto assets and intermediaries are regulated by the Commodity Futures Trading Commission or the Securities and Exchange Commission. Now, that did pass with a little bit more bipartisan support at 294 to 134. That bill now goes to the Senate for consideration. And the third crypto bill was the Anti-CBDC Surveillance State Act, also known as H.R. 1919. So this was an ICBA-supported bill to bar the Federal Reserve from issuing a U.S. central banked digital currency to consumers. Now, this passed strictly on partisan lines. This was strictly a 219 to 210 vote. I think one Democrat voted for it. And again, this bill now goes to the Senate for consideration. Here's the problem, and here is what was holding this bill up earlier in the week. The Republicans that were, dissenting or were concerned about this bill, they were basically looking at it and they were not happy with it because they feel like this anti-CBDC Surveillance State Act bill, which is what they were really concerned about. This is the one they really want to basically prevent the Fed from being able to issue a central bank digital currency. They feel like this is going to have a very difficult time of getting through and passing in the Senate, which I don't disagree with. And so their concern was that the Genius Act was basically setting up the back door for basically going to set up all the rail system, the rails, everything, if you will, for the central bank to basically then be able to come in and just put a central bank digital currency on top of it, sell it along with other cryptocurrencies, and away we go. And that was their big concern. That was the big holdup. And again, they had a tough time, which I don't understand. Why would anybody be against blocking the Fed from having a central bank digital currency? I don't understand why that became such a partisan vote, more so than the other ones. Like, why did the Genius Act not become so partisan? Why did the Clarity Act not become as partisan? Like, it's a little strange to me that happened. And I do share their concerns because we do not want a central bank digital currency. That is absolutely not something that we want. And there are a tremendous amount of repercussions if we do get that. There's a lot of dangers in a central bank digital currency. And so I've been very adamant about getting this bill done. I'm glad they did get it done. Now it goes to the Senate, and now we'll have to see what happens with it in the Senate. But again, just to reiterate, I do understand the concern that the Genius Act is now law, and the anti-CBDC Surveillance State Act, which is super critical. I mean, all three of these bills are critical to the overall framework around cryptocurrency and stable coins and everything else that we do. So we really need all three of these bills to pass to really set up the true framework around these things. So, but like I said, so far so good. They did pass the House. They are off onto the Senate. The Genesis Act did get signed into law, which is great. So now it's 1 down and 2 to go. So we'll see what happens there. But now I want to point out the part about the deposits. So digital assets legislation must protect against community bank disintermediation. So ahead of House consideration of several digital asset bills this week, ICBA urged Congress to ensure a regulatory framework for today's largely unregulated digital assets industry provides regulation without jeopardizing investors, destabilizing the financial system, or disintermediating community banks. So the new ICBA letter, in a letter to members of the House of Representatives ahead of the vote on all these bills this week, stablecoin and market structure legislation must not create a shadow banking system that offers fewer protections to consumers and imperils the ability of community banks to provide capital and credit to local communities. New stablecoin and market structure laws should first do no harm nor undermine the existing supply of credit. And then also, lawmakers must work to fully mitigate the risks to the economy that would result from an outflow of community bank deposits to payment stablecoins. So there are some concerns here. So if anybody has watched the crypto series that I have done, I basically in a couple of the episodes there, I did one episode on a report that came out from the Treasury just a few months ago, where the Treasury highlights a lot of concern around this topic and basically says, yes, if stable coins, if all this legislation goes through, and if stable coins really do take off and begin to mature and really find another gear here, they could begin to siphon off as much as 20% of the current deposits that are in the banking system right now. I mean, right now, I think there's about 20 trillion in actual deposits in the U.S. banking system, and up to 20% of that, so you're talking a few $1 trillion there could get siphoned off and go into stable coins, and thus, you start dramatically reducing deposits. Now that could be an issue with lending money and credit and getting credit into the economy. So there's definitely concerns there with how that's going to work. Now, I think the White House would probably push back on this and probably say something to the effect of, well, that depends on how quickly banks decide to kind of get with the program and jump into this. Now, the big banks undoubtedly are, I mean, JP Morgan's, they've got, I think, a lot of stuff pretty much, ready to go in terms of issuing stable coins and things of that nature. PNC Bank just released an article this week. They're looking at doing a bunch of things. Obviously, one of the main banks that's dabbling in crypto right now is like Customers Bank, a little bit, a lot smaller than the big four, but still having a certain amount of success, handling digital deposits, or not just digital deposits, but digital products. And so it's going to be really interesting to see what happens now, because obviously, we hope these other two bills get passed, without, too much problem. And that basically the three bills together really begin to create this regulatory framework and scope around stablecoins and cryptocurrencies, and really helps to expand upon the crypto market, as it were, because getting more people involved in it and getting more people comfortable with it and making it yet a little bit more mainstream. So again, this is the hope here with a lot of this stuff. But again, banks are always kind of slow to jump on a lot of this new stuff, and but we'll see. I think a lot of the a lot of your core system providers, your fintech providers for the banking space, I mean, I think a lot of them are just going to go gangbusters now and really start to beef up, just all of the products and all of the back end software and technology, so that banks can offer these digital products. So banks can be, offer a digital wallet and be a custodian, and maybe, get into, maybe even work with like JP Morgan or something to start to issue, more stable coins, or provide stable coins for their customers. So again, I love the saying here, this could be perhaps the greatest revolution of financial technology since the birth of the internet. I don't think that is an understatement at all. I don't think that's an understatement at all. I mean, I think this is going to, this could change a lot. And I'm not saying it's going to change a lot overnight, but this is definitely taking us in a whole new direction. And it's going to be fascinating to see where this goes and how this all plays out. So, okay, so I want to jump in. So this week was earnings week for all the big banks. So I wanted to cover the big six. I've got a bunch of articles here on that. Then we're going to talk some tariff stuff. Then we're going to talk about the Fed and all the what's going on there with Jeremy Powell. I got inflation numbers for this week and a bunch of other articles I want to cover, as well as later in the program, we will get into what are the economic indicators coming out next week. What were my episodes that I put out this week, and what are some maybe some things coming up in the near future. So with that being said, Fed's Waller calls for July interest rate cut. Yes, my man. He's not only calling for that rate cut, he is pushing that resume hard. Federal Reserve Governor Christopher Waller said policymakers should cut interest rates this month to boost a job market that looks to be weakening. Waller said tariffs are one-off increases that don't cause persistent inflation, and noted that the central bank shouldn't wait until the labor market deteriorates before we cut the policy rate. His comments come as Fed officials remain divided between those who believe inflation is tame enough to justify cutting the central bank's federal funds rate versus those who are concerned that tariffs will increase price pressures. So, and again, this is now the second time that Waller is calling for an interest rate cut. And I think that, I love this. I love to see some dissension in the Fed. And, but as I've said in the last few weeks, this is the key thing. Will there be dissenting votes? That's the big thing. Talk is cheap. What I want to see here is I want to see these Fed governors get in this room when they go for their meeting this week. I really want to see them sit down, and I want to see what kind of dissenting votes are there. I want to see Waller put his money where his mouth is. I want, when he gets into that meeting, if he doesn't agree with Jeremy Powell on the interest rates, I want to see a dissenting vote. Same thing for Mickey Bowman. If she wants to see decreasing interest rates, and and she doesn't agree with Powell's direction, I want to see a dissenting vote. I want to see some dissenting votes here, because that is ultimately what is going to put pressure on Powell to start cutting rates. And but like I said, we'll come back to this more when we start talking about Powell's issues in a little bit. But like I said, I just wanted to put this out there that we have once again, we have another Fed governor who's out there saying, hey, we need to cut rates. We need to make something happen. I wanted to talk about this for a second. FDA authorizes Juul's e-cigarette after ban nearly bankrupts firm. Now, what did I just do with that? I'm not sure what I did with that, but I've had a thing here. All right. Anyway, so I did one of the almost first episodes that I did on the podcast. I did episode number 25. I did a documentary review of what was called Big Vape: The Rise and Fall of Juul, and it was a documentary that was on Netflix. And I covered it because I really thought it was a really interesting story, just about what had happened with Juul and the vaping trend that exploded and the health problems that it caused. And I saw this yesterday, and I was just absolutely floored that this, regulators allow Juul's original vaporized and refill cartridges in tobacco and methanol flavors to remain on the U.S. market. U.S. regulators authorized Juul Labs to keep its e-cigarettes on the U.S. market after a 2022 ban pushed it near bankruptcy. The FDA determined the product's benefit for adult smokers outweighed public health risks. Let me say that again. The FDA determined the product's benefit for adult smokers outweighed public health risks. Juul represents about 18% of e-cigarette sales in U.S. stores, tracked by Nielsen, according to a Goldman Sachs analysis. U.S. regulators authorized Juul Labs to keep its e-cigarettes on the U.S. market, breathing new life into the vaping company after a 2022 federal ban pushed it to the brink of bankruptcy. The decision removes Juul from the limbo it has been mired in since then, not knowing whether its products would be allowed to remain on store shelves. With clearance from the Food and Drug Administration, Juul could now raise money from the outside investors or sell part or all of the company. Juul was once a vaping juggernaut and one of the most valuable startups in America, but in 2022, the FDA ordered Juul to halt its sales because of unresolved questions related to the toxicology data that Juul had submitted in its application to remain on the U.S. market. Though the ban was quickly put on hold and Juul's e-cigarette sales resumed, the FDA ban sent Juul into a financial tailspin. Juul's co-founders and 2 board members had to put up the money for the company to settle thousands of lawsuits alleging that Juul had marketed its addictive devices to children and teens. Juul narrowly averted bankruptcy, and its workforce shrank to a fraction of its former size. Juul has denied allegations that it marketed its e-cigarettes to children and teens. In its new decision, the FDA determined that the product's benefit as a less harmful alternative for adult cigarette smokers outweighed any potential public health risks, including to young people. A spokeswoman for the Department of Health and Human Services said Thursday the move gives the green light to Juul's original vaporized, along with refill cartridges in tobacco and menthol flavors. I just can't even believe this. I am just beyond this. For anybody who watched the documentary, go back, watch that episode 25. It's also in, if you're on YouTube, you can go down. I have everything categorized on the channel page. You can go down to movie reviews and documentary reviews. You can find episode 25, Juul, the Big Vape. This is just unbelievable. When you watch that documentary and you find out the harm and the damage that vaping does and has done to kids, it's just mind blowing. I cannot believe that the FDA, after a number of years here, would come out and basically say that, like, oh, well, we know that this is harming young people, but it's okay because we don't think it's quite as bad as just, smoking plain old cigarettes. When in actuality, it's far worse than smoking cigarettes. And it all has to do with the delivery system of, on the cigarette, you have a filter. And the cigarette is also wrapped in paper. And the vaping product, there's no filter. It just goes and it just plows right into your lungs. It is far more addictive and it's instantly addictive because you are basically getting a straight shot of nicotine right into your lungs. And thus all the kids jumped on it. Not to mention the fact that, their little cartridge packs, their flavored cartridge packs, that, people were putting all kinds of crazy stuff in that, all kinds of, marijuana related products and stuff like that. So it's, I don't like vaping. I don't like e-cigarettes. I think this stuff should absolutely be banned. I just think, like I said, I saw this article. I wanted to share it with everybody because I thought it would be a good follow-up to the episode that I did. And hopefully I would hope that it would bring a little bit of awareness there, and people would go back and hopefully watch that episode that I did again, or go to Netflix and just watch the documentary. I think it's a 3-part, documentary on Netflix. Go back and check it out because it's eye-opening. It is extremely eye-opening, and I think it will change your mind on vape. If you're somebody who doesn't think that vaping's not that bad or is not that big of a deal, go back and watch that documentary. I think you will absolutely change your mind. Go back and watch episode 25. Okay, enough on that for the moment. All right, let's get into some earnings here. I want to go over the big six, top 6 banks of the country. This was earnings week. How did they do? So JP Morgan Chase tops estimates on stronger than expected trading and investment banking. So here's what the company reported. They had earnings of $5.24 a share. They had revenue of $45.68 billion versus $44.06 billion estimates. So they topped estimates, which is great. JP Morgan Chase on Tuesday topped analyst estimates on better than expected revenue from fixed income trading and investment banking. They, like I said, basically earned $5.24 a share. May not compare with the $4.48 a share estimate. Their revenue, $45 billion. Now think about that. That's quarterly 45 billion. So that means annually they're bringing in about 200 billion in annual profit or annual revenue, which is just it's just staggering. They're bringing in probably about 200 billion in annual revenue. They're probably making about 24 billion in annual profit because they're probably making about 5 billion a quarter. Which, or no, more, they have to be more than that if they were making 20. So they're probably doing about 20 billion a year in profit, which is just, which is insane. It's insane numbers. And let's see here. How did Bank of America do? So Bank of America puts up mixed results as net interest income misses analyst expectations. So Bank of America profit climbed about 3% from a year earlier to $7.12 billion or 89 cents per share. Revenue climbed about 4% to $26.61 billion, which was below analyst expectations. And CEO Brian Moynihan pointed to the larger trends at his bank, saying that it was the 4th consecutive quarter that net interest income rose amid rising deposits and loan growth. So overall, certainly not terrible for Bank of America. But they were the only major U.S. bank to fall short on revenue for the quarter. But still, revenue of $26.61 billion. Again, not too shabby. Only narrowly missing the expectation of $26.72 billion. So basically, Bank of America said that profit climbed about 3% from a year earlier to $7.12 billion or 89 cents per share, topping the 86-cent estimate. Revenues did rise about 4% to $26.61 billion, below analyst expectations, as the firm generated $14.82 billion in net interest income, missing the street account estimate by $70 million. The company said that net interest income, which is the difference in what a bank pays its depositors and what it earns from loans and investments, rose about 7% in the quarter as deposit and loan growth were offset by lower interest rates compared with a year ago. CEO Brian Moynihan pointed to the larger trends at his bank, saying that it was the 4th consecutive quarter that net interest income climbed amid rising deposits and loan growth. Big American banks have benefited from strong trading results and consumer credit that has held up in the first 6 months of the year. Consumers remained resilient with healthy spending and asset quality, and commercial borrower utilization rates rose, Moynihan said in the earnings release. In addition, we saw good momentum in our markets businesses. So that is the comments from Mr. Moynihan. Now let's check in on Wells Fargo. So Wells Fargo profit beats estimates, Cut to interest income forecast weighs on shares, however. Now, remember, Wells Fargo just got out of their asset cap that had been under for a number of years due to the lingering effects from the sales scandal that had enveloped them a few years back. But Wells Fargo beat second quarter profit estimates on Tuesday, but cut its 2025 guidance for net interest income, sending the shares of the lender down 2% in trading before the bell. The bank expected its interest income to be roughly in line with the 2024 level of $47.7 billion. In April, it said net interest income growth would be at the low end of the 1% to 3% range. Wells Fargo said lower interest income in its markets business led to the net interest income forecast cut. Analysts and investors were skeptical about its ability to meet its interest income targets after a slow start to 2025. While there continues to be risks, activity levels have remained consistent, and our strong credit performance continues to point to the strength of our commercial and consumer customers' financial position, said CEO Charlie Scharf. The bank had expected its net interest income, or the difference between what it earns on loans and pays out on deposits, to be relatively stable in the first half of 2025, with more growth in the second half. Heading into the results, some analysts expected the bank to cut its net interest income forecast as elevated interest rates weighed on demand from borrowers. So Wells Fargo beats estimates, but like I said, has this cut to net interest income in their forecast. And people aren't optimistic that they're going to be able to beat it. So now let's go to Citigroup, rounding out our big four here. So Citigroup beats second quarter estimates as markets and banking revenues jump. So Citigroup reported total markets revenue that was higher by 16% versus the same period a year ago. Banking was another bright spot, with revenue up 18% over the second quarter of 2024. Volatility is going to, I suspect, be a feature, not a bug, of the New World Order, and we will benefit from that, CEO Jane Fraser said. So, Citigroup reported second quarter results on Tuesday that topped analyst expectations, helping to boost a stock that has already been outperforming the broader market. Citigroup's net income of $4.02 billion climbed 25% from the same quarter last year. Here's how the bank's results compared with Wall Street expectations. So earnings were $1.96 per share versus $1.60 per estimate. Revenue of $21.67 billion versus $20.98 billion estimate. Shares of Citigroup rose 3.7% after the report. The firm's revenue rose 8% from $20 billion a year earlier as it saw growth across its major business groups. Citigroup reported total markets revenue that was higher by 16% versus the same period a year ago. Equity revenue alone rose 6% year over year and was up 7% from the first quarter. Banking was another bright spot, with revenue up 18% over the second quarter of 2024, even with losses on loan hedges. We're improving the performance of each of our businesses to take share and drive higher returns, CEO Jane Fraser said in a statement. With revenue up 8%, services continue to show why this high return business is our crown jewel. Markets had its best second quarter performance since 2020, with a record second quarter for equities. Banking revenues were up 18%, and we continue to be at the center of some of the most significant transactions. The latest results reported Tuesday included the turbulent market period that began in early April. That type of volatility can help boost profits in equity and fixed income trading in major banks, Citigroup said. Volatility is going to, I suspect, be a feature, not a bug, of the New World Order, and we will benefit from that, Fraser said on an analyst call Tuesday. More negatively, Citigroup reported 16% growth in cost of credit, fueled in part by a higher net build in the allowance for credit losses. The bank cited deterioration in the economic outlook relative to last year as a reason for the move. Fraser added that the overall environment has proven to be more resilient than expected, but the bank is seeing slowdowns in hiring and capital expenditures by clients. So, very interesting here. And then let's go to the last two. Let's see here. Goldman Sachs tops estimates as traders generate $840 million more revenue than expected. So Goldman Sachs on Wednesday posted results that topped expectations as its trading operations generated $840 million more in revenue than analysts had expected. The bank said the second quarter profit jumped 22% from a year earlier to $3.72 billion, or $10.91 per share. Revenue climbed 15% to 14.58 billion, roughly 1.1 billion more than the estimate. And then we see here Morgan Stanley earnings top estimates on increased trading revenue. So Morgan Stanley on Wednesday reported second quarter results. They crushed Wall Street expectations on the back of higher trading revenues. Here's what the bank reported for the second quarter compared with what Wall Street was expecting based on the survey. So earnings per share, $2.13 versus $1.96 expected, and revenue of $16.79 billion versus $16.07 billion expected. Net income rose 15% to $3.54 billion, or $2.13 per share, from $3.08 billion, or $1.82 per share for the same period a year ago. Revenue increased 12% from $15 billion. So institutional securities reported net revenue of $7.64 billion compared with about $6.98 billion a year ago. The strong performance was propelled by higher client activity with notable strength in equity trading. Morgan Stanley delivered another strong quarter. Ted Pick, CEO and chairman of the bank, said in a statement, 6 sequential quarters of consistent earnings reflect higher levels of performance in different market environments. Wealth management was another strong segment for the bank, which delivered net revenues of $7.76 billion on higher asset management revenues. A year ago, the business saw revenue of $6.79 billion. So again, doing very, very good. Our, the second quarter earnings here for the Big Six looking very strong, coming in very good. The only bank out of the Big Six to disappoint, and not even really disappoint that much, was Bank of America. The Bank of America just kind of narrowly missed. Wells Fargo, while again, a little bit of issue there, because while they did beat estimates, they basically said their long-term net interest income, their long-term outlook for the rest of the year basically was below what was expected. So again, maybe not the best 2025 for Wells Fargo, or at least what they were hoping for out there. Citigroup appears to be in a good position, certainly better than what they had more recently had, given a lot of the troubles they had gone through over the last year or so, with just laying off a lot of employees. Saw a couple little minor scandals here and there, little issues going on, but bouncing back nicely. Definitely bouncing back nicely there. So here are a couple of follow-up articles to these earnings that I just wanted to point out to everybody. So banks are thriving so far in Trump's economy. Here's what that means for markets and the consumer. So Wall Street is humming thanks to a boom in stock and bond trading and a pickup in corporations acquiring competitors and taking out massive loans. At the same time, Main Street is holding up as the American consumer continues to spend, borrow, and repay loans, according to reports this week from the largest U.S. banks. It makes for an unusually profitable environment for financial firms. The 6 biggest U.S. banks generated $39 billion in second quarter profit, outstripping analyst expectations and collectively jumping more than 20% from core earnings a year ago. It's a remarkable result from a tumultuous start to the quarter. The period began with shock and plunging markets on April 2nd over President Donald Trump's sweeping Liberation Day tariffs. Doesn't everybody feel like a smack you know what now for overreacting and acting ridiculously from the April 2nd announcement? Like I said back in April 2nd, I said this is completely all this hype and doom and gloom is completely overblown. Wasn't going to happen, hasn't happened, and now look at this. We got rock solid earnings. Things are moving. The bond market's moving. M&A is moving. Consumers are still spending, and unfortunately for Chicken Little, the earth is not falling apart. Here's another article. We're doing fine. Here's what big bank execs say about consumers this week. So the American consumer, they're doing fine. That's the take. At JP Morgan Chase, one of several large U.S. financial institutions to report results in recent days, coverage of JP Morgan's earnings, along with reports for Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo, and Citigroup, consumers remained resilient with healthy spending and asset quality. Bank of America CEO Brian Moynihan said in a press release, inflation data for June released this week indicated an uptick, while retail sales numbers for last month are due to be released Thursday. Now, I'll save everyone the suspense. The retail sales numbers were really good, up very nicely. Bank earnings are watched not only by those who care about the health of a bank's business, but also for the data and commentary on the state of the economy. Here's a selection of comments from bank executives from conference calls made available by AlphaSense, lightly edited for readability. JP Morgan Chase CFO Jeremy Barnum, the consumer basically seems to be fine. If you look at indicators of stress, not surprisingly, you see a little bit more stress in the lower income bands than you see in the higher income bands, but that's always true. What's pretty much definitionally true, and nothing there is out of line with our expectations. Our delinquency rates are also in line with expectations. You saw that we kept our net charge-off guidance unchanged. So all of that looks kind of fine. And to be honest, as we've said before, fundamentally, while there are nuances around the edges, consumer credit is primarily about the labor market. And in a world with a 4.1% unemployment rate, it's just going to be hard, especially in our portfolio, to see a lot of weakness. Citigroup CEO Jane Fraser, the strength of the U.S. economy driven by the American entrepreneur and a healthy consumer has certainly been exceeding expectations of late. As I've been speaking to CEOs, I've yet again been impressed by the adaptability of our private sector, aided by the depth and breadth of the American capital markets. Wells Fargo CEO Charlie Scharf from the company's call. As we look ahead, what we see regarding the health of our clients and customers has not changed. Consumers and businesses remain strong as unemployment remains low and inflation remains in check. Credit card spending growth softened very slightly in the second quarter, but is still up year over year and remains strong overall. And debit card spending grows. Growth has remained strong and consistent with what we saw in prior quarters. Consumer delinquencies continue to improve from a year ago, and commercial credit performance continues to be relatively strong. Deposit flows for both our consumer and commercial clients were in line with seasonal trends. So again, there you have it. Comments from the big four, basically saying that the consumer is hanging in there just fine. Again, nothing's perfect. It could be. I think it could be better. I don't think that maybe the labor market is as good as what a 4.1% unemployment rate would indicate. I think there's a lot more turbulence there in the labor market than perhaps those numbers allude to. But again, so far so good. Things seem to be rolling along okay there in terms of that. So again, great quarter for bank earnings. Just absolutely blew away expectations for the most part. We see their comments. They feel like business owners and consumers continue to hang in there and continue to do okay, which is fantastic. And we shall see. We'll just see what the rest of the year brings. So. Okay, let's switch up here a little bit and let's talk some tariffs here for a few minutes. Okay. So Trump announced this week that they had a deal with Indonesia. So in this article basically says Trump says Indonesian trade deal features 19% tariff. Jakarta confirms call with U.S. president. So President Donald Trump said he has reached a deal with Indonesia a week after he threatened to slap a 32% tariff on the Southeast Asian country's U.S. exports. The U.S. will impose a 19% tariff on Indonesian goods as part of the deal, Trump said. Indonesia is one of the United States' top 25 trading partners, with the two countries trading more than $38 billion in goods in 2024, according to the Commerce Department. So what we have seen so far, we have now seen deals with the UK. We've seen deals with Vietnam. We've seen deals with Indonesia. So again, these deals maybe not coming as fast as what we would have thought, but I did say when this, again, going back to the whole Liberation Day narrative, back to April 2nd, I did say that I thought that this whole thing would probably take about 6 to 12 months to play out, and that there would be a lot of stops and starts. There would be a lot of fits. There would be all kinds of back and forth negotiations. And that basically we would see the economy, stock market, a little bit of up and down, a little bit of volatility as we worked our way through this. But we also got basically I would say the very beginnings of a trade deal with China, which has also helped to kind of stabilize things at the moment. I have a very interesting article about that here in just a second. But as we move on here, so Trump threatens 100% tariffs on Russian export buyers unless Ukraine peace deal is reached by September. So President Donald Trump said he is disappointed with Russian President Vladimir Putin over his ongoing invasion of Ukraine. We're going to be doing very severe tariffs if you don't have a deal in 50 days. Tariffs at about 100%. They call them secondary tariffs, Trump said at the White House. Trump threatened secondary tariffs on Russia earlier this year, but the deadline is new. So could be hitting Russia with a lot more in tariffs. I don't really know what that is ultimately going to do, if anything, to Russia at this point. Remember, Russia's already been under economic sanctions for a few years now, and they have found ways around it. They have worked ways around the deal. They've worked with Russia, and they have worked with Iran, and they have worked with North Korea and Brazil, and they've found a way to keep their economy humming. So I don't know. I don't know what the additional tariffs. I don't know how much pain that's really going to cause them, but we'll see. Trump pushes for up to a 20% minimum tariff on the European Union, as per the Financial Times. Trump has escalated his demands on the EU following weeks of negotiations over a possible framework deal, the Financial Times reported. The EU had been hoping for a deal similar to the UK's, which maintained a 10% baseline tariff with some sector exemptions. Trump has often bemoaned the EU's 198 billion euro, 231 billion dollar trade surplus in goods with the U.S. I would say this. I think that the European Union probably could have got that 10% tariff, but they cried and moaned, and they pounded their chest, and they were going to show Trump how tough they were. And that's not working out so hot for them now. It's not working out so well for them now. Again, going back a couple months ago, I said the really smart countries were going to be the first ones in the door here. They were the ones who were going to make the trade deals, and understand that, hey, this trade dynamic is completely changed, and it's completely changed, and it's probably not ever going to go back to the way it was before, because once we see the true amount of income. We've just gotten a taste of the tariff revenues that are coming in these last few months. We've just gotten a taste of it. When these much higher amount of revenues start rolling in, it is going to be very difficult for any president. Okay, so Trump's done it in 3 years. A new president comes in the door. Say it's a Democratic president. Okay, it's going to be incredibly difficult for if you got $500-600 billion a year in tariff revenue rolling in the doors. It's going to be very difficult for any president thereafter to basically make the argument that tariffs don't work and you can't make the tariff revenue, and we don't need that revenue. We could just get rid of it, whatever. This is a paradigm shift here. What we're seeing, it's a paradigm shift. And again, that's why I said the countries that got in the door here first were the ones that were going to cut the best deals, were the ones that were going to be in the best position. The European Union, again, decided to wait, and now they're going to get it now. U.S. President Donald Trump is demanding a minimum of 15 to 20% tariffs on imports from the European Union, the Financial Times reported Friday. According to 3 people briefed on trade talks between the U.S. and the bloc, Trump has escalated his demands following weeks of negotiations over a possible framework deal. Less than 2 weeks ago, to go until Trump's August 1st deadline, talks between the two powers appear to have stalled. The EU had been hoping for a deal similar to the UK's, which maintained a 10% baseline tariff with some sector exemptions. Trump has often bemoaned the EU's 231 billion trade surplus in goods with the U.S. For its part, European Union officials say that trade is much more balanced when services and investments are taken into account. They have also pledged to increase oil and gas purchases to narrow the trade gap. Not gonna happen here. They're gonna end up paying 15 to 20%. That's what's gonna happen. They're not gonna like it, but that's what's gonna happen. Okay, now here was the interesting article that I talked about with China. So China posts record trade surplus as exports rebound. So exports to the United States, however, remained negative, falling by 16.1% from a year earlier in June. So China announced on July 14th that its trade surplus reached 586 billion in the first half of the year as exports regained momentum in June following the de-escalation of trade tensions with the United States. Outbound shipments climbed by 5.8% from a year earlier in June, up from May's 4.8% increase, according to data released by China's General Administration of Customs. The result beat the 5% growth expected by economists in a Reuters poll. Imports climbed by 1.1% from a year earlier in June, reversing a 2.9% decline in May and marking the first growth so far this year. Chinese customs data show analysts had projected a slightly higher increase of 1.3%, according to Reuters. Overall, during the first half of this year, the country exported 1.81 trillion worth of goods and services while importing 1.22 trillion, according to the Chinese customs data. The resulting surplus of 586 billion was nearly 35% higher than the 435 billion recorded last year. The widening of the trade imbalance came at a time of heightened concern in Western economies about Chinese exports. The United States, the European Union, and other regions are worried about job losses and factory closures in sectors flooded with low-priced Chinese products. Citing the trade imbalance and other reasons, U.S. President Donald Trump increased the tariffs on Chinese products to as high as 145% in April. In response, China retaliated by raising tariffs on U.S. goods to 125%, blacklisting dozens of American companies and tightening export controls on rare earth magnets and other strategic deals. June marked the first full month after Beijing and Washington agreed to pause most of their tariffs for 90 days. Exports to the United States fell by 16.1% in June from a year earlier. Let's see here. And so that's what you kind of have here with what's going on here with China. So China is seeing kind of a rebound here, but it's just interesting for a couple of reasons. So number one, I would ask, is that really what we want to see here? Do we really want to see China continuing to just import more and more goods here? The U.S. and the EU and a couple other regions are basically concerned that China is going to basically hurt their economies and hurt their businesses by basically just flooding the block with low-priced Chinese product. And that is a big concern and should be a big concern for a lot of companies out there. And we'll see how this plays out throughout the rest of the year in terms of these trade talks. Like I said, the potential trade deal there where they basically said, hey, okay, we're going to de-escalate things between the U.S. and China. We're going to de-escalate a little bit. We're going to pause on some of these tariffs for a little bit. And, China got some relief. China opened back up access to some of the rare earth materials, minerals, and things that we need to get from China. So again, it's all kind of quiet at the moment. I feel like depending on what China does here, because China's not just going to stand down. They're going to keep poking the bear because that's what they do. So again, I think that in the next couple of months, we will probably see another flare up in the U.S. China relations as things continue to don't work out the way that we would like or the president would like, because once again, China again doesn't want to fully play ball or doesn't want to come to the table and operate as an honest trading partner. But like I said, I could be wrong. Don't think I am, but we'll see what happens there. Okay, and this was an interesting article from the Wall Street Journal. So forget taco. Trump is winning his trade war. So the president wants tariffs, the higher the better. Whether that is achieved unilaterally or via deals is secondary. So we have a nice, interesting chart here. Estimated U.S. average effective tariff rate. So we can see the effective overall tariff rates have been climbing. President Trump has announced that tariffs will rise sharply on key trading partners on August 1st, absent any new deals. Markets and foreign negotiators have responded with a shrug. After all, Trump paused the bulk of his tariffs in early April, and his team promised as many as 90 deals in 90 days. The 90-day mark came and went a week ago, and there has been just one deal with Britain and concepts of deals with Vietnam and Indonesia. The dearth of deals to date has fed the narrative that Trump always chickens out, the so-called taco trade, that he overplays his hand and that his trade war is going badly. This narrative misconstrues Trump's goals, overstates the importance of deals, and breeds complacency about his willingness to raid tariffs. Going into his second term, many of Trump's own advisors like to portray tariffs as a negotiating chip to get other countries to lower their own trade barriers and buy more American stuff. Trump himself never subscribed to this. He has been clear and single-minded about his goal. He wants tariffs. The higher, the better. Whether that is achieved unilaterally or via deals is secondary. Trump advisors argue that only tariffs can effectively address trade deficits, which they say reflect the plethora of non-tariff barriers such as regulation and taxes that suppress consumption and imports. Yet, since the 1890s, Trump has advanced a similar rationale. Others should pay for access to the U.S. market or the protection of the U.S. military. And despite the absence of deals, he has succeeded. In June alone, Treasury collected $27 billion in customs revenue, up $20 billion from a year earlier, a pace that would imply $240 billion more a year. That isn't even enough to eliminate most families' income tax, as Trump once promised, but it can still pay for plenty of other priorities. The idea that Trump backs down dates to April when he announced steep reciprocal tariffs on almost everyone and 145% on China, markets cratered, and walked the tariffs back, but he never relinquished his 10% baseline tariff on almost all imports. When he first floated such a tariff on the campaign trail, it seemed like a worst case scenario. Today, many trading partners now see that as a best case scenario. Including his tariffs on steel, aluminum, and autos, the average effective tariff on all U.S. imports as of July 2nd was 13.4%, according to JP Morgan Chase. That's below the April 9th peak, but well above the 2.3% last year and the highest since the 1940s, before the U.S. and its allies set up the mechanisms to bring down world trade barriers. So even without deals, Trump has, by his own definition of success, already won his trade war. Trump's ambivalence regarding trade deals seems out of character for someone who prides himself on the art of the deal. Yet, as a private developer, Trump understood that deals generally require everyone to give something up. Trump couldn't dictate terms to bankers or investors when he needed them more than they needed him. Today, he leads the world's largest economy with the largest military. Everyone else needs the U.S. more than vice versa, and Trump assumes that he can thus dictate terms and that others have to live with them. There's a lot of truth in that. There's a lot of truth in that. And I would say, again, I think the point there is that, Trump had, so even without the deals, Trump has, by his own definition of success, already won his trade war. There you have it. I think this is a great article just pointing out the fact that, hey, forget this taco trade. A lot of people in the administration, and as I have always said since January, that the tariffs are a negotiation tactic. That has always been the thing. The threat of the tariffs, the negotiation tactic. It's a tactic to get people to come to the table. Come to the table. Let's cut a deal. Let's make a deal. Let's see what we can come up with. Like I said, I think a lot of the countries are foolish for not coming to the table and not cutting a deal sooner. Why that is, I have no idea. I don't know. Some people just want to, they don't want to look weak, or they don't want to lose face or whatever. But again, the premise being that these countries need us a lot more than we need them. And that's the wake-up call to the world. That's the wake-up call to the world. Like, we don't need you. You need us. We don't need you. Therefore, we have leverage. Therefore, if you don't want to work with us, then you're gonna get the bad end of the stick on this. So again, just pointing this out so people see this, because again, I think a lot of the tariff stuff, it is going very good. We're seeing record revenue coming in. Deals are forming a lot slower than people thought, but that's okay. It's still working out the way we want, and we're not seeing this, so-called. I'll get into the whole inflation talk here. I'm not forgetting about that. I've got all the inflation numbers from this past week. We're going to go into all that in a little bit, but first, I want to jump into obviously the Fed news with Powell and all that stuff that's going on here. But again, just to wrap up on the tariff thing. Tariff, so far so good. I think everything's going very well on this, and Trump is succeeding in this. Trump is succeeding with his tariffs, so that's great. That's great for all of us. That's great for all of us. That's less, hey, look, we just had the the big beautiful bill with a bunch of tax breaks come in, and you might say, well, okay, well, how are we going to pay for those tax breaks? Well, tariff revenue. That's how we're going to pay for those tax breaks. I would rather us, if you want to call tariffs a tax, that's fine. I think they are. But I'd rather be taxing the rest of the world than taxing all the lower and middle income people here in America. So that's my take on it. So there you go. All right, let's talk some Fed stuff here. Let's get in here. So Trump certainly can fire Chair Powell if there's cause, says Hassett. So National Economic Council Director Kevin Hassett said the White House is looking into whether it has the authority to fire Federal Reserve Chair Jeremy Powell. President Donald Trump has said that he does not want to fire Powell, but Hassett's comments suggest that top administration officials are still considering the possibility. The Trump administration has zeroed in on the Fed's $2.5 billion renovation project as a possible cause for removing Jeremy Powell. Now, earlier this week, I think starting out, Monday and Tuesday, there were all these articles and just posts all over social media flying around, basically saying, "Hey, Jeremy Powell is getting fired." Donald Trump, he's already written up the letter, the letter basically demanding that Jeremy Powell be fired, be terminated immediately. But then they backed off of that. They backed off of that real quick and basically said, "Okay, yeah, we're not gonna fire him." But then, like I said, then Kevin Hassett, he came out and basically said, like, "Yeah, of course Trump can fire Powell if there is a reason, if there is a cause there," and thus they've been, Bill Pulte, some other who's the head of the FHFA, he's been just hammering Jeremy Powell, relentlessly hammering him for the last few weeks, basically calling for his resignation, saying that he should be fired. Now they've been zeroing in on this just completely ridiculous renovation project that the Federal Reserve has going. And that leads us to our next thing here. So Kevin Warsh touts regime change at Fed and calls for partnership with the Treasury. So former Federal Reserve Governor Kevin Warsh called Thursday for sweeping changes on how the central bank conducts business and suggested a policy alliance with the Treasury Department. Their hesitancy to cut rates, I think, is actually quite a mark against them, Warsh said on CNBC. Warsh is considered one of the 3 or 4 finalists to take over at the Fed, and he expressed multiple sentiments in line with what Trump wants. So basically, we've got a bunch. We got the 2 Kevins I reported on last week. You got the 2, Kevin Warsh, Kevin Hassett, the 2 Kevins. Along with Waller, a couple other people are all, they're all, jumping in, trying to win the favor of President Trump and trying to get named as the next chairman of the Federal Reserve. So to kind of point the picture here of what we're looking at. So former Federal Reserve Governor Kevin Warsh reported on President Donald Trump's short list to lead the institution, called Thursday for sweeping changes on how the central bank conducts business and suggested a policy alliance with the Treasury Department. "We need regime change in the conduct of policy," Warsh said during an interview on CNBC Squawk Box. "The credibility deficit lies with the incumbents that are at the Fed, in my view." Principal among those holdover officials is Chairman Jeremy Powell, who repeatedly has incurred Trump's wrath and is certain not to be reappointed when his term expires in May of 2026 if attempts aren't made to remove him before then. Warsh is considered one of 3 or 4 finalists to take over, and he expressed multiple sentiments in line with what Trump wants from the Fed. The president has demanded the central bank cut its benchmark overnight borrowing rate and has urged Powell to resign for not pushing for cuts. Warsh's comments indicate he could be at loggerheads, not only with the way Powell has led the Fed, but also with holdover members who would be in place should he be put at the organization's helm. Their hesitancy to cut rates, I think, is actually quite a mark against them, Warsh said. The specter of the miss they made on inflation, it has stuck with them. So one of the reasons why the president, I think, is right to be pushing the Fed publicly is we need regime change in the conduct of policy. So I like the comments. I like the sentiment. I like this idea of like change of policy. I think I think it needs to go a lot further than that. I'm going to take a step back here for a second. I am not one of the people I'm not one of the end the Fed people. However, Do I believe that the Federal Reserve needs to be basically neutered? Yes, I do. I do think the Fed needs to be neutered. I think we need major changes to the Federal Reserve Act. And anybody who tells you they can't make changes to the Federal Reserve Act, I got news for you. They've been making changes to the Federal Reserve Act since the day the Federal Reserve Act was put in place in 1913. There has been an endless stream of changes to that. And usually the changes go one way, and that is giving the Fed more and more power. And that power needs to be reduced. It needs to be cut back. And now we're gonna get into just a second here. I think I might have okay. So now I'm going to show you guys a few articles here that I thought were really interesting. And I think this is going to play into one of my points here. The markets will crash if Trump has the power to fire Fed's pal, Senator Elizabeth Warren says. So Elizabeth Warren, aka Chicken Little, warned that U.S. markets will crash. Oh no. If President Trump can fire Federal Reserve Jeremy Powell, saying the central bank's decision must remain independent of politics. Saying that the Fed is independent of politics is just one of the biggest jokes of all time. The Fed is not independent. And I'm sorry, I thought it was called the Federal Reserve. I thought it was the Federal Reserve, meaning that they are part of the government. They're part of the federal government, thus the Federal Reserve. The Federal Reserve should not be independent. And I have very, very strong feelings on this. You go back, you study history, you study the history of this country. The Federal Reserve was not the first central bank the United States has had. It was the third. It is the third central bank that the United States has had. The first two, the first bank of the United States and the second bank of the United States were the first two central banks the United States had. They were killed off by a couple of guys named James Madison. You might know that name. He was the guy that, wrote that thing called the Constitution. It was also taken away by Old Hickory, Andrew Jackson. He killed the second bank of the U.S. And Thomas Jefferson wanted to stop the central bank, or wanted to get rid of the central bank, but he was unable to during his term, left it to James Madison. Now, what did all three of those gentlemen say? What was their contention against the Federal Reserve or a central bank, for example? Well, their premise was that a central bank is a direct threat to the power of the presidency. And if you give a central bank too much power, they will basically bankrupt everybody in the country, and they will basically take all the money and give it to their banking cartel, which is exactly what we have seen repeatedly again and again over the last 110 years of the Federal Reserve. And we can go back to this. This isn't controversial stuff here. And I believe that to be absolutely true. And an independent Federal Reserve, as they like to put it, you've already seen this, with a head of the Federal Reserve that does not answer to the president. That means you're basically saying that the head of the Federal Reserve is more powerful than the president of the United States. It's more powerful than the presidency. That basically the presidency has no power over the Federal Reserve. And I think that needs to change. That needs to absolutely change. I think, and this is not a Trump thing. This is any president thing. I want you to think about it not in terms of who the president is. I want you to think about the office, in terms of the office and the power of the office. And I think that any president should be able to fire the head of the Federal Reserve if the head of the Federal Reserve is not doing a good job. Jeremy Powell is not only doing a bad job, he is doing a horrific job. He has been doing a horrific job since the day he got in there. We could go back to 2019 when he decided to bail out all the hedge funds when their basis trade blew up on him. Obviously, people don't talk about that one. Because he did that one on the sly, and then COVID happened and basically took that out of the headlines, because that would have been a major scandal that probably would have ended Mr. Powell's tenure at the Federal Reserve had that gotten to play out like it normally would have. Now let's look at where we're at right now. Federal Reserve has a $1 trillion hole in its balance sheet in unrealized losses in their bond portfolio. Over $1 trillion hole right now. They have lost $235 billion in the last 2 years. Their balance sheet still insanely high, still over, $6.7 trillion on their balance sheet that they ballooned up from all the spending, all their pumping in. These are not these are not strong accomplishments here. This is what you call a train wreck. And now he last year he lowers rates when he shouldn't have, in a totally political, totally partisan, totally political move. Lowered the interest rates when he shouldn't have, when all the signals were saying that inflation was going to ratchet back up and they shouldn't cut the rates. So what did they do? They cut the rates and inflation ratcheted back up. Now that we have inflation coming down for the last 6 months, now they refuse to cut the rates, because once again, making it a total political decision. So and I could give you dozens and dozens of examples of the Fed playing total politics over the last 100+ years. So this idea that the Fed is this nonpartisan, non-political, holier than thou art institution that doesn't, couldn't possibly, get brought into the fray of these minor political squabbles. No. Let's just stop. And I want to show you another article here, because here, look, what happened this week? All the big bankers, they all came to Powell's rescue. JP Morgan's Diamond warns against playing around with the Fed as Trump pressures Powell. JP Morgan Chase CEO Jamie Dimon said Tuesday that the independence of the Federal Reserve remains critically important. The comments come after President Donald Trump has spent months pressuring Fed Chair Jeremy Powell to lower interest rates. Playing around with the Fed could have adverse consequences, the absolute opposite of what you might be hoping for. This is ridiculous. Let me ask everyone a question out there. And please give me feedback on this. Comment. Put your comments in here. Is if Jeremy Powell gets fired tonight, tomorrow, next week, is that going to have any ramifications on your life whatsoever? No. Zero. None. Zilch. As a matter of fact, whoever gets put in there next will be a better head of the Federal Reserve than Jeremy Powell, guaranteed. Any of the candidates that are out there right now are going to be far superior to Powell. And within a month or two, everyone will totally forget Jeremy Powell. They'll totally forget him. And I believe, and I've said this before, if you want to go to my Lords of Easy Money series, why don't you go to the interview I just did with former Fed Governor Dr. Thomas Honig. Go watch that interview that I just did with him. I believe that in the next, and it will take time. I believe in the next 15, 20, 25 years, as people have a chance to reassess this time period, as Christopher Leonard brilliantly did with the book, The Lords of Easy Money. You're going to see other books on this time period. Once Powell is gone, that is the end of an era at the Fed. The end of the era of what I call the Three Amigos. I should write a book called The Three Amigos. Ben Bernanke, Janet Yellen, and Jeremy Powell, the three amigos at the Fed, that have overseen perhaps the most horrific period in the tenure of Fed governors. And I think that basically the history is going to show that these three wrecked our economy and did, horrendous damage to our economy over this, 18 year period of time here. And I don't think history is going to look very, very kindly on the three of them. And Jeremy Powell, for basically, because they just, Yannett and Powell just carried on Ben Bernanke's policies. Everything that Ben Bernanke wanted them to do, they did. They just carried it on for another 10 years, 12 years. But who does this hurt? Does this hurt? Who owns the Federal Reserve? Well, the big banks own the Federal Reserve, of course. So that thus hurts the banking cartel. Thus that hurts, Jamie Dimon doesn't want to see that. The heads of all the big banks don't want to see that. But for the everyday person out there, your small business owner, your everyday American citizen, firing Jeremy Powell means absolutely nothing. And all this fear mongering of, the economy is going to implode and, it's going to be terrible. And, give me a break, please, save your tears, please. It's a bad joke. It's a bad joke. And then here's another article, the global risks that come with the loss of an independent Fed. It isn't just the U.S. Other countries have also come to expect an independent U.S. central bank. So now, again, the fear mongering. Trump's threat to oust Fed Chair Powell raises questions about the global economy without an independent U.S. central bank. Experts warn a White House-controlled Fed could struggle to act fast and credibly during fiscal threats, undermining its stability role. Economists fear a Fed shakeup could increase uncertainty and hurt its credibility, impacting both the U.S. and global economies. Oh no! Oh no! Come on, man, really? This is just so. This is just so weak, and it shows you. But it shows you these headlines. When you look back at this, markets will crash if Trump has power to file PED. J.P. Morgan, Diamond says playing around with the Fed. This is bad. He shouldn't do this. It's bad. Oh, the global risks that come with the loss of an independent Fed. Oh, this just shows you that they are afraid. They are afraid that things could dramatically change here at the Fed. That for the first time, I would say for the first time in the history of the Fed, and this is why I said this 6-7 months ago, when Jeremy Powell and everybody, he's beating his chest. Oh, Trump can't fire me, and I'm going to do what I want, and forget you people, and this and everything. I'm not going to do anything. I'm going to do whatever I feel. This and that. I said, he better be careful. And I said this repeatedly. He better be careful because he's going to get what he wishes. And he's going to get a lot more than he wishes for. And because again, this isn't about him. This is about the future of the Fed. I said, you've got probably, I would say, half of the Republicans in the Congress would love nothing more than to put forth a major bill. Basically, like I said, completely changing the Federal Reserve Act, stripping the Federal Reserve of all kinds of powers. Believe me, there is a big chunk of Congress that is just salivating, that would have no problem putting forth something like that. So be careful what you wish for. That's all I'm going to say. Be careful what you wish for. And again, as you look at the history of the Federal Reserve, you look at their performance. It's not controversial to say that they have failed miserably. They have failed miserably. And I can't say that point enough. And it's not controversial to say that. What is controversial is why. Why? That is the controversial thing. Okay, let's keep rolling here. Just got a couple more things on this topic. So Trump appointees pushed more marble in Fed building renovations while the White House now attacks. So President Donald Trump has looked to the marble finishes and hefty price tag of the Federal Reserve headquarters to claim grounds to fire Chair Jeremy Powell, with whom he has tussled for years over interest rates. But the extensive use of marble in the building is, at least in part, the result of policies backed by Trump himself. As the Fed moved forward with plans to renovate its Great Depression-era headquarters in Washington during Trump's first term, it faced concerns in 2020 during a vetting process involving Trump appointees who called for more white Georgia marble for the facade of the buildings. The Fed's architect said the central bank had wanted glass walls to reflect the Fed as a transparent institution, but 3 Trump appointees to a local commission felt marble best fit the building's historic character. Marble was added as a result, according to the minutes of the Commission of Fine Arts, which advises the federal government on architecture. The marble does not explain the roughly $600 million in cost overruns. Now we're getting to the real thing here. The marble does not explain the roughly $600 million in cost overruns for the Fed headquarters and another nearby office building now budgeted to cost $2.5 billion, which also includes the addition of an underground parking garage and new glass atria in the building's courtyards. But the roots of its extensive use further muddies the White House's attempt to use the renovation to paint the central banker as a profligate spender as a possible pretext to remove him. I think this is ridiculous. And if anybody has been paying attention to this week, they would know that there have been a lot of memes and things that have been put out there basically showing the number of professional football stadiums that were built for less than this. Think about $2.5 billion to renovate these couple of buildings. It's insane. It is absolutely insane. No, and again, this, as far as I know, there were talks about renovating these buildings 5-6 years ago. I do remember that, but there was never any mention about a $2.5 billion price tag. That was never ever discussed. I think if that was discussed, if that was the case, that would have been flat out turned down on its face. There's no doubt about that. I mean, they probably went in and said, oh yeah, it's going to be $500 million, whatever, blah blah blah. But okay, all right, whatever, But $2.5 billion. I mean, this is just, it's nuts. So, and then the Fed Chair Powell responds to White House questions about the HQ renovations. So, Federal Reserve Chairman Jerome Powell formally replied to White House OMB Director Russell Vought on July 10th letter, which asked pointed questions about the Fed's headquarters renovation. Powell explained the reasons that the project cost had exceeded its initial budget and denied that the renovated offices would include luxurious extras. That's a bunch of nonsense. Vaught's letter was the latest chapter in President Donald Trump's campaign to pressure Powell to step down. And yeah, so again, they've got this stuff. And then Powell also put up on the White House. Let me see if I have this here. So then Powell asks the Inspector General to review the $2.5 billion renovation after Trump blasts the Fed project. The Federal Reserve has brought in its Inspector General to review a building expansion that has drawn fire from the White House. Shame they didn't do that a year ago. We've got a real problem of oversight and excessive spending. Yeah, no bleep. Yeah, no, yeah, no, yeah. We all know. Yeah, we all know it, man. All right, we're gonna get back to that in just a second, but I just want to finish my point on the Fed. So Jeremy Powell, the Fed updated the frequently asked questions page. Okay, the frequently it's just, I mean, this is such a weak response. It's ridiculous. Okay, if Powell had a leg to stand on, he would go out and immediately have gone out and done a press conference and said, hey, listen, here's what happened, blah blah blah, whatever. But it's so egregious. He can't go out. He can't go in there and say, oh, yep, we wanted our offices coated in gold. We needed champagne rolling. We needed a champagne waterfall here in the main lobby. We needed caviar served every day at noon. We needed, Powell couldn't get up there on national TV and say this in front of people because people would have been horrified as they should be. So instead, he puts out this weak letter. They update the frequently asked, questions on the webpage. I mean, just a totally weak and feckless response from Powell and the Fed, which is because you can't justify this. You cannot justify this gross spending at a time when we're sitting here at a time when we're $27 trillion in the hole. Okay, upper left-hand corner here, 27 trillion in the hole. You can't justify this. There is zero, there's just zero justification for this. None. So now again, will this be enough to fire Powell? Probably not. But again, they're going to ride him. They're going to ride him now. And if this, and I would say if this doesn't work to push him out, the next step is they will name his replacement. His replacement will go in there at the Fed, and then that replacement will basically just undermine him for the next 9 months, and basically just ride him out the door. So I think that sooner or later he doesn't want to go. There are people I think behind him in DC that don't want him to go. But again, I think sooner or later his time is going to be up. All right. So what do I want to do here? Okay. So at this point in the show, I want to take a break. We're going to come back to all the economic gators. We're going to get to all the inflation information and all that. I still got a bunch of news articles and stuff to get to. But at this point in the show, this is where I like to go into what are the weekly economic indicators that are coming up for this week. I also want to read a very short blog post to you guys on basically how banks are doing so far under President Trump. And then I also want to give you guys talk about the episodes that I put out this week and also what banking news we've got. We got a lot of banking news. So, okay. Economic indicators. What is coming up this week? So on Monday, July 21st, we have U.S. leading index. On Tuesday, July 22nd, Fed Chair Jeremy Powell is going to speak at 9:30 a.m. The FOMC member, Michelle Mickey Bowman, is going to speak at 1 o'clock. And then we get the API weekly crude oil stock at 4:30. On Wednesday, July 23rd, we get existing home sales, the 20-year Treasury bond auction. Thursday, July 24th, we get continuing jobless claims, initial jobless claims, building permits, manufacturing PMI, services PMI, and new home sales. And then finally, on Friday, July 25th, we get durable good orders, Atlanta Fed GDP now for the second quarter, and the U.S. Baker Hughes total rig count. So a lot of economic indicators coming out this week. We get some labor market, some housing numbers. Obviously, Tuesday is going to be a big day with Powell speaking and then Michelle Mickey Bowman speaking. Notice the times there. Powell's going to speak at 9:30 on Tuesday, and then Mickey Bowman is going to speak at 1 o'clock. So my bet there is that Powell's going to speak at 9:30. He's going to talk about the renovations and all the nonsense with that. But then he's also going to talk about the upcoming meeting and maybe allude to whether or not they're going to do any interest rate cuts. And then Michelle Mickey Bowman's probably going to come out at 1 o'clock saying we need rate cuts. We need rate cuts. So like I said, keep an eye out on some of the economic indicators coming up this week. So, okay. All right, let's hear. I want to read this. I've got this blog post here that I thought was really good that I just wanted to read everybody. So this is called The Populist President. So at Bank Directors Acquire or Be Acquired conference last January, a reporter asked me why I thought President Donald Trump would roll back consumer protection regulations. After all, she said, Trump is a populist. It turns out the Trump administration and Congress have been delivering for the financial services industry, not for the consumer protectionist camp. So let's review. First off, the Biden administration had capped credit card late fees for large issuers at $8. The current administration asked a federal judge to cancel that rule, and it was done. Similarly, Congress and the president used a mechanism to overturn the prior administration's rule capping overdraft fees for banks and credit unions above $10 billion in assets. Under this administration, the Consumer Financial Protection Bureau has abandoned prior lawsuits and consent orders against multiple banks and even credit unions. The latest was a consent order against Vienna, a Virginia-based Navy Federal Credit Union that would have required that the institution pay a $15 million penalty plus more than $80 million in refunds to consumers for overdraft fees. Further, the so-called One Big Beautiful Bill Act, now signed into law, will slash funding to the CFPB. The Bureau regulates banks above $10 billion in assets for the benefit of consumers, but the agency has been controversial since its inception. Critics point to overzealous regulation and rulemaking by enforcement action, as well as its funding structure. The CFPB's funding comes from the Federal Reserve, not from Congress. The law cuts that funding from a maximum of 12% of the Federal Reserve's operating expenses to 6.5%. The bill includes other wins for the banking industry. For example, it extends tax breaks for S corporations and other pass-through entities that were set to expire at the end of the year, ensuring parity for S corporations with tax reductions put in place for other types of corporations in the 2017 Tax Cuts and Jobs Act. One thing seems clear, at least when it comes to financial regulation, the banking industry is winning. So I thought that was very interesting to point that out, and I just want to point out and note a couple things on there. So, I am a big proponent of regulation, but you also have to understand there is a thing known as over-regulation. There is a thing known as government overreach, as regulatory overreach. These are very real things. The Biden administration lost their mind. They went off their rocker. Their government overreach was bad at first, and then it went into hyperdrive insanity in the last year or so of his administration. So it's not a question of the Trump administration like deregulating. They weren't deregulating. They were basically reining in all of that ridiculous overreach. When we talk about BOI and open banking and the 1071 rule and all this other garbage, it's just, dramatic government overreach. Just the gumming up of the M&A market, making M&A deals take 3 years to get done and making, banks and companies jump through all these ridiculous hoops to get their deals done. I mean, just, all these crazy things that we talk about. I look at it more so just returning to normalcy. This is a return to normalcy. They just want the banks to operate as normal. You talk about just the stress testing and how just how things are done in some of the regulatory circles. Not looking at this, when examining, not looking at this so-called the reputational risk, so to speak. These are really good things for the banking industry. This just gets banks back to operating as normal. That's the whole point. Get them back to operating as normal. There's again, and the better banks function as normal, the better our economy is going to run. Credit is going to be plentiful. Consumers are going to be happy. Business customers are going to be happy. That's the whole point. If you want a booming economy, you can't have banks tied in knots and have a booming economy. It just, unfortunately, for better or for worse, it does not work like that. And that's not to say deregulation. That's not to say, oh, we're going to cut all this regulation, we're going to do this, we're going to do that. No. Banks are still extremely well capitalized. Banks still have a ton of liquidity. You compare banks now to what they were, say, like pre-07, like if you go back to like 05, 06, banks are, light years more stable and light years more sound than they were back then in those years. So again, I think we're just seeing a return to normalcy here. We're seeing an administration that's basically saying, hey, we're not cutting all the regulation away, but we're also not going to make it impossible for you guys to just do your job. And I think that's what you're seeing. So, all right. So like I said, just wanted to share that with everybody real quick. So, okay. What were the episodes that I had come out over this last week? So did a couple of interviews this week. On Monday, I had episode 424 that came out. It was an interview with Jim McCarthy from consulting firm McCarthy Hatch. Very interesting business. Basically, so the episode was an interview with Jim McCarthy, the founder of McCarthy Hatch. McCarthy Hatch is at the forefront of innovation in the consumer financial industry, driven by their groundbreaking FSAI technology. Jim and we discussed his business, his background, how the company aids their clients in real-time risk prediction, the FSAI technology, and what the current regulatory landscape looks like. Very interesting revenue. Jim's company works with all of the biggest banks. Jim was actually one of the founders of the CFPB, and basically carried that over into the private sector, founding McCarthy Hatch and developing this FSAI technology, which is basically a risk prediction type of software package that basically helps the biggest banks. All of his clients are basically the top. I guess maybe say like the top 25 largest banks of the country. He helps them to work with the CFPB by predicting potential risks that may be on the horizon based on all their different data in different parts of the bank. So very, very interesting business. Very interesting what he does there. I tell people to check that interview out. And then on Tuesday, I did episode 425, which was an interview with Rob Titterington from Highland Consulting Group. Now, Rob has been on with me before. He is a bank recruiter. This time, though, I think Rob and I had a very interesting conversation around AI and how AI is affecting banking from that perspective. Like, in other words, in this episode, Rob and I discussed the current landscape of artificial intelligence and how it is affecting financial services. We cover job applications, hiring. What are AI skills? Will jobs go away? What's the potential for job augmentation by AI? What is the potential for increased capacity caused by AI? So again, we had a very interesting conversation around AI and how it's affecting the job market, with you will, in a lot of different ways in terms of job posting, the so-called ghost posting, all this kind of stuff. So it was a very, I thought it was a very good, very enlightening conversation. I think a lot of people would be very interested. So check that out when you have time. Then on Wednesday, I did episode 426, which was, should people be investing in stock tokens? Now, this wasn't a crypto series episode, although I added it to that series just because it kind of falls in there with that. But this episode examines a series of articles on what are known as stock tokens. What is stock tokenization? Is it a real investment? Is it a real asset? Robinhood stirred a lot of conversation over the last week by rolling out stock tokens to their customers in Europe. The two companies they are focusing on are OpenAI and SpaceX. OpenAI immediately came out and said that they gave no permission to Robinhood to issue a stock token on behalf of the company, and this token is in no way representing equity in the business. Then SoFi got into the action, basically saying that they were going to offer private funds around these same two companies. So it just, again, I don't like this idea of stock tokens. I think this is a total scam. You have no ownership. You have no equity. There is no stock ownership in any of these companies. This is basically just a way for Robinhood to make a few bucks on the side, basically selling you something that is totally fraudulent. It is absolutely not what they are advertising it to be. And I just think that's very dangerous. Now I'm working on the upcoming updated crypto series installment for this week. I'm going to be talking more about this because there's been a lot more backlash to this topic, but I saw it last week or so, and I was like, man, this is really interesting. And it was just something one of those topics I just came onto that I wanted to cover that I thought people would be interested in it. So then on Thursday, I did episode 427. What Chime's example could tell us about a smart marketing budget? So this episode examined an article from Cornerstone Advisors titled, "You Don't Need a Chime Marketing Budget to Make Smart Marketing Investments." Now that Chime has become a publicly traded company, they have released numbers around their marketing budget. For the first time, we can compare what banks and credit unions are spending on marketing compared to one of the fastest growing fintechs. While Chime is spending considerably more on marketing than banks and credit unions, the article then compares all three to SoFi. Should banks be doing more in terms of marketing spend and getting more creative around marketing? That is the big question from the episode. But I thought it was really interesting. The numbers there on Chime and what Chime is spending, what they're spending to acquire their customers was very, very, very interesting compared to what banks and credit unions are currently spending. I think there's no doubt that banks could be doing a lot more in terms of their marketing in all areas. What are they spending on it? How are they doing it? What's their strategy? I think there's there's a lot more that banks can absolutely be doing in that area. So like I said, check that episode out if you like. And then on Friday, I did another installment in the crypto series. This was called, obviously, Crypto Week from the Crypto Week that we just had. So this was part 24 of the crypto series. In this episode, we review multiple crypto-related articles. The week was dubbed Crypto Week by the U.S. Congress because of the 3 crypto bills that were passed. The Genesis Act is scheduled to come up for a vote, which it did, and it passed. In other news, Bitcoin flies to all-time high. Omega Pro is charged with crypto fraud. BNY Mellon will have custody of Ripple's new stablecoin. Strategy, which is MicroStrategy, buys another $530 million worth of Bitcoin, and Cornerstone Advisors provides a breakdown of what banks need to know about the Genesis Act. So again, thought it was another great installment in the crypto series. If you haven't checked out the crypto series, please go check that out. If you're, like I said, again, if you're on the YouTube page for the channel, you can just scroll down. It has all the crypto series episodes listed out. You can go check that out. I think there's a ton of great stuff in there. But that was my that was the 5 episodes that I had out for this week. Just a note. So I do put out 5 episodes a week, Monday through Friday. They always premiere every day at noon. Those episodes are usually shorter in length, usually only about 10, usually about 10 to 20 minutes. In full length there. So go check those out when you have a minute. I really try to make those more digestible in terms of like the content length, just because, hey, it's something you can listen to if you're, driving to and from work, if you're on your lunch break, or, maybe something interesting to listen to, or if you're at the gym or something like that. So I try to make those episodes shorter and try to make them on very specific topics that I like to cover. So, Okay. So let's get into some banking news here for a second. Okay. Let's see here. Rural Economic Index expands again in July. Retail sales up in June, as I said a little while ago. So retail sales increased a seasonally adjusted 0.6% in June, and we're up 3.9% from a year ago. If you recall, back in May or a couple of weeks ago, everyone was bemoaning the death of the consumer. That did not hold true. Business inventories do remain flat in May. And then mortgage rates rise. So the rate for a 30-year fixed rate mortgage was 6.75% this week, up from 6.72% last week. I will have some more numbers on that in just a few minutes. Let's see here. I'm going to talk about that in just a second. Digital asset bill clears procedural votes. Yeah, we talked about that. Agencies propose rescinding the 2023 CRA final rule. So the federal bank regulatory agencies issued a joint proposal to rescind the Community Reinvestment Act final rule issued in October of 2023 and replace it with the prior CRA regulations after the FDIC Board of Directors advanced the proposal earlier this week. So basically in October of 2023, again, Biden administration came out with this ridiculous update to the CRA rule that was just, when I talk about, the government overreach and just some of the crazy things they were doing, that was one of it. And now that thing is toast and is getting rolled back, which is a great thing. So hallelujah. FHFA issues Q&A on credit score transition. So the Federal Housing Finance Agency released additional details on Director Bill Pulte's recent announcement that the agency's transition to the VantageScore 4.0 credit scoring model will be optional. So they put out basically a list of questions. They're looking for feedback on that. I have reported on this before that basically they're what's called the FICO 10T, which was validated and approved for use by the enterprises alongside VantageScore 4.0 in 2022, remains an approved credit score model and is planned for future use by the enterprises. So they are looking to kind of incorporate these new credit scoring models in some of the underwriting for mortgages. So, and right now, like I said, the VantageScore 4.0 will be a new option that will be coming in here at some point, and we'll, see what happens with that. Judge overturns rule that removed medical debt from credit reports. So a federal judge in Texas reversed an ICBA opposed Consumer Financial Protection Bureau rule that barred consumer credit reports from including medical debt. So U.S. District Judge Sean Jordan said the rule is not permitted under the Fair Credit Reporting Act. The CFPB earlier this year asked the judge to strike down the rule, saying it had exceeded its legal authority. So absolutely. Again, we've seen this trend in recent years to remove a lot of stuff that's on the credit report. They want to remove tax liens and judgments and things of that nature. And then after that was done, then they moved on to the medical debt. They wanted to get rid of the medical debt. And then, just this constant, chipping away at things that should be on there. Now, why is this a problem? Well, this is very much a problem, not just for banks, but anybody who's looking at your credit for anything, any type of financial services product, insurance, what have you. They're pulling a credit report on you. They want to see, do you have, what debts and things do you have out there? Do you pay your bills on time? Do you have other issues and stuff like that? There's a lot that gets cut away with that. And now they're saying that basically like, hey, they couldn't take the requirements for reporting medical debt off of the credit report. So now that stuff is gonna go back on, which again, I don't think that is a bad thing because you have to be able to when underwriting, you have to be able to get a complete picture of what the person or individuals is doing, right? Okay, FDIC requests input on ILC charters. So during its board meeting, the FDIC issued a request for public comment as part of a comprehensive review of the industrial loan company charter and the issues proposed by such applicants. I've done episodes on the ILC charter. You could go check that out. FDIC proposes ICBA advocated threshold adjustments. So the FDIC proposed raising various regulatory thresholds to account for inflation and to allow future adjustments using an indexing methodology as advocated by the ICBA. So very interesting. So we'll have to follow up on this one and see what happens with that. FDIC proposes new supervisory appeals process. So the FDIC proposed amending its guidelines for appealing material supervisory determinations to make the process more independent. So that's good. I like that. FDI proposes rescinding CRA final rule. We have that. Congratulations to the University of Tennessee at Martin. They won the community bank case study competition. So the Conference of Bank State Supervisors announced that a student team from the University of Tennessee and Martin is the winner of the 2025 CSBS Community Bank Case Study Competition. So teams from the University of Arkansas and Illinois State University placed second and third. So congratulations. This year, 35 teams representing 27 colleges and universities partnered with local community banks to explore the impact of interest rates and inflation on the business of banking, with a focus on planning for the future through branch strategy, technology, and managing regulatory burden. So again, congratulations to the University of Tennessee at Martin for winning that competition. OCC says it will no longer examine banks will examine them for disparate impact. That is fantastic. Love it. Get rid of that nonsense. Agency issues statement on crypto asset safekeeping. So the federal banking agencies issued a joint statement to provide clarity on banks' engagement in crypto asset related activities, highlighting potential risk management considerations related to holding crypto assets on customers' behalf. So again, interesting stuff with all the other things we had coming out. FFIEC releases flat file. NACHA says new fraud rules are crucial. Agencies propose to revise and extend call reports. Good stuff. And then ICBA releases updated issue brief on digital assets legislation. So yeah, I think I reported on maybe some of that last week. And then I think I might have just had one or two other things here. So President Donald Trump is set to open up, and I do have an article on this I'll share with you guys in a minute. President Donald Trump is set to open up the $9 trillion U.S. retirement market to cryptocurrency investments, gold, and private equity to change the way American savings are managed, the Financial Times reported. Citing people briefed on the president's plan, Trump is expected to sign as soon as this week an executive order that would open up 401k plans to alternative investments beyond traditional stocks and bonds. So that is fascinating. PNC is considering introducing data access fees for fintech firms, similar to what JP Morgan Chase & Company is pursuing. CEO Bill Demchak said on an earnings call, we're in discussions on it. I applaud what JP did. I think they're exactly right. I think there's a big cost to keeping this data secured and producing in a form that's readable for our clients. So we're thinking about it. So in other words, this is related. It gets back to open banking. I have been adamantly opposed to open banking. I don't want open banking, and again, I would tell people to go back and look at my episodes that I've done on open banking. If you don't know what that is, I don't want it. But to be fair, one of the big issues that I pointed out with open banking was that basically the regulation, which was again put forth by the CFPB, then their open banking rule, which was the 1033 rule, they wanted to basically force banks to just, basically just put the data out there. So in other words, if Google shows up at their door, plugs an API into the back network of the bank and just siphons out all the customers' data. Okay, that was it. And I thought that was absolutely ludicrous. I mean, why would the bank's data is their most valuable possession, in my opinion, is the most valuable thing that a bank owns. Why in the world would you just give that away for free? So there was zero profit motive in any bank doing this, and it was going to add millions of dollars in cost to build out the portal, to increase cybersecurity, increase cyber insurance, you name it, and that doesn't even get to the heart of the matter of giving away customers ultra sensitive data to whoever comes along and asks for it. What? what what happened to privacy? What happened to the Fourth Amendment? Like it's nuts. The rule is nuts. But again, what you're seeing here is that obviously there are people that are pushing for this, and now you're seeing like JP Morgan came out, and now PNC Bank is coming out and saying, well, wait a minute. If we can get paid to do this, then hey, let's reconsider. Let's reconsider. If you guys will give us a profit motive, that might be a way for you to get this through. So again, these bigger banks now are starting to throw a lifeline to this and say, hey, we might be okay with this if you can give us a profit motive. So again, just weekly stuff there. So okay. All right, we still got about 15 minutes or so left here, and so I've got to still have a bunch of stuff I want to run through with everybody, so hang tight. So weekly mortgage demand plummets 10% as rates and economic concerns rise. Yeah, I mean, interest rates tacked up a little bit in the residential market, not too much, but again, and I just reported on this just to kind of give everybody an idea of what's going on, but rates have been going back and forth, so nothing too crazy with that. Let's see here. Nearly 1/3 of major U.S. housing markets now see falling home prices. So nearly 1/3 of the largest 100 markets are now showing annual price declines, according to ICE, a mortgage technology firm. Not ICE. We're not going to get into all that. But this is a mortgage technology firm. Okay, different ICE. Inventory has been rising steadily over the past year, up 29% in June compared with the same month last year. Prices are still seeing big gains, however, in the Northeast and the Midwest. So again, just something to keep our eye on here. Home builders are slashing prices at the highest rate in 3 years. So builder confidence has been in negative territory now for 15 straight months. Confidence rose slightly in July due to the recently passed budget bill. Buyer traffic saw a 1-point drop to 20, which is the lowest reading since the end of 2022. So yeah, I mean, builders are in a tight spot. They're trying to get houses built, but the affordability right now, the interest rates, the cost of materials, everything is just not, nothing is going in their favor at the moment. So they're struggling a little bit with getting product out there. So okay, let's talk some inflation stuff here. So inflation picks up in June, rising at 2% annual rate. Now this is on the CPI. So we're going to talk about the CPI and the PPI. Consumer Price Index. So a broad-based measure of goods and services costs increased 0.3% on the month, putting the 12-month inflation rate at 2.7%, in line with expectations. Core inflation picked up 0.2% on the month, with the annual rate moving to 2.9%, with the annual rate in line with estimates. While the evidence in June was mixed on how much influence tariffs had over prices, there were signs that the duties are having an impact. Apparel and home furnishing prices rose, though vehicle prices fell. President Donald Trump used the report to initiate another call for the Fed to lower interest rates. So let me tell you, and I'm going to show you here in a second. This CPI report went up for one reason and one reason only, and that was because energy prices jumped a little bit for the month. It was not because of tariffs, and I'm going to show you some articles here of this kind of fear-mongering nonsense. So here's the inflation breakdown for June 2025 in one chart. So let's go down here again. Eggs. Think about where eggs were. Eggs were over 100%, and now they're down to 27.3 and continuing to come back down. But here, this is where the big pop was. It was in energy right here, 14.2%. For utility, pipe gas services, and electricity, 5.8%. This is what caused the inflation number to tick back up just a tad here in June. And again, energy is gonna fluctuate a little bit. So there was nothing of any real concern with this, and you immediately saw all these article headlines like, oh, it's the tariffs are jumping in. We're finally starting to see the tariff action, and I'm gonna show you this, but that is not what happened here. So now let's look at the PPI for just a second. So wholesale inflation measure was unchanged in June. So the producer price index, a measure of wholesale costs, showed no change in June. Against the forecast for a 0.2% increase, the same was true for the core PPI. Though the numbers for headline and core wholesale inflation were subdued, Final demand good prices rose 0.3%, but were offset by a 0.1% fall in services. So combined with Tuesday's consumer price index release, the data suggests that President Donald Trump's tariffs are indicating only a marginal bite on the U.S. economy. I wouldn't even use marginal. I would use zero. Zero would be the correct answer there. So, oh, look at this. What do we have here? Inflation outlook tumbles to pre-tariff levels in latest University of Michigan survey. So the University of Michigan survey of consumers for July showed overall sentiment rose to 1.8% from June to 61.8, exactly in line with the estimate and at the highest since February. On inflation, the outlook in both 1 and 5 year horizons both tumbled, falling to their lowest levels since February. Now, what is fascinating about this is from a political perspective, it's crazy when you look at the different. So from a political perspective, Democrats think that inflation's going like this. Republicans think inflation's going down. And so part of, University of Michigan, they're trying to, balance these two things. What are people really looking at? I guess now you're finally starting to see that some of the Democrats are finally starting to come around to realize, you know what? We're probably not going to have this ridiculous spike in inflation. And probably inflation is probably going to may linger a little higher, but is ultimately probably going to come down here. And I think you're starting to see that sentiment, turn. But again, here's just a couple of nonsense articles. Inflation flared in June as tariffs take a toll. Like, I mean, really, that's not what happened. You had a small tick up in energy prices, and it nothing to do with tariff costs. Fed's beige book flashes tariff price alarms. Just again more fear mongering, just nonsense. They're just you could see that certain parts of the media they're just desperate. They're desperate to have so they can run out and proclaim, oh, see, we were right. His tariffs wrecked the economy. Oh, look at all this inflation. It's just So I just wanted to point that out. So that's basically where we are in inflation. Again, nothing, again, the numbers were down. Tariffs didn't have anything. We saw a tiny little bump in the CPI. And again, that was all because of a slight pop in energy for the 1 month. And I always remind everybody, 1 month does not a trend make. You have to look at it over you look at the course, you look at the last 6 months, and inflation has just been coming down very nicely. It's been coming down very nicely. Everything's trending. Everything is trending still the way that we want. The PPI showed that there was just nothing there. And I'm sure we'll get the CPI in another week or so, and then that'll give even more validation. Okay, couple more articles here. So Trump's big beautiful bill caps student loans. So here's what it means for borrowers. Starting in mid-2026, President Donald Trump's massive tax and spending package will set new limits on student loan borrowing. Experts predict this new policy could have lasting consequences for higher education. Yes, it's called that colleges are not going to be able to just increase their price tags to whatever they want them to be to pay for their ridiculous degrees and their ridiculously over-bloated budgets and the multi-million-dollar pay packages for their deans. That stuff is going to stop. You're going to have to wait for it. You're going to have to cut your prices if you want kids to be able to continue going to your school and affording your product. Yes, I think this is a great thing. I have said for a long time that the growth of college tuition has far. You look at college tuition over the last 30 years, and it compared to inflation, it is like quadrupled inflation. And that is because the government has kept the spigot for student loans open. So that means that, whatever the student needs, the government, here you go. Oh, you need 50 grand. Hey, here's 50 grand. You need 100 grand. Here's 100 grand. You need 200 grand, 300 grand, 400 grand. Here you go. And now we're finally putting a cap on that, meaning that the student's going to say, hey, this is what I can borrow, and this is what I can afford. And then the school is going to have to make the decision. do they want to take that, or do they they're going to have to rein in their price increases. They're going to have to rein this stuff in. So very interesting indeed. Why Blackstone is buying rental homes in the U.S.? That is a wonderful question there. Why is Blackstone buying up all these houses? Blackstone is an American alternative asset manager, private equity company with significant interest in rental housing. In recent years, the company spent billions acquiring brands such as Tricon Residential, American Campus Communities, and Air Communities. Blackstone's rental housing portfolio contains apartment complexes, student housing, mobile home parks, and single-family rental properties. Many of their U.S. assets are concentrated in major cities such as New York and in the Sun Belt states, including Texas, Georgia, and Florida. Man, I do not like this. I cannot stress how much I hate this. You've got BlackRock, you've got Blackstone, you've got all these other private equity firms that are just running around buying up all the housing inventory, especially around single-family houses. Something needs to be done about this. This is ridiculous. Like, people can't buy houses because Blackstone is rushing in there to buy the house, and they'll just pay cash, and they'll pay up to buy that house, and then they'll just rent it out forever. This is causing problems in the housing market. It's morphing the housing market in ways that perhaps we can't yet fully grasp or fully understand. I think this practice needs to stop. I think they should be stopped from buying single family houses in the mass quantities that they're buying them. And I think they should be made to put these houses back on the market, quite frankly. But again, I digress. I'll have more on that at a later time. Here's an article I really want to get into, and I'll probably have to save this more for next week. So, locked out of the dream. Regulation making homes unaffordable around the world. Okay, so this is an article really pointing out how the American dream is really in trouble, and how buying a house is a cornerstone. It's incredibly fundamental to the realization of the American dream. And if people can't buy houses, that's a major problem. That is a major, major problem. And part of the issue why they can't buy houses is the regulation, just the cost of having to build a house because of the regulation involved in it. So that's just one aspect of the building industry, one problem, if you will. But I'm definitely going to come back and cover this article in a lot deeper detail, because it definitely needs it. It's at a huge talking point. Trump issues regulatory relief for coal, chemical manufacturing, steel industry. So Biden-era rules enforce stringent emission standards, which the Trump administration says are detrimental to national security. Yes, coal, chemical manufacturing, and steel industry. Yes, we need to get those things rolling. Can I ask a simple question? Why is chemical manufacturing so important? Well, when you think about the process of building this thing called microchips, these things that we need to power anything and everything that we have and use, chemicals play a massive role in the making of microchips in the semiconductor process. So in the semiconductor process, some of the big parts are you have the machines. So you have a semiconductor, you have a fab, and you have the machines in those facilities. Then you have the companies that make the wafers, the chip wafers. Then you have the companies that design the chips. Okay, you have a number of companies out there that just design chips. They don't actually make them. You have the companies that make the chips, and then you have the companies that design the chips. But then you have the machines and the wafers, and it's called the lithography process. You have to have chemicals that go into the machine that makes the whole process work. And that is a key component to the logistics, the supply chain, if you will, of the semiconductor industry. That's why we need more of those chemicals here in the U.S. right now. In order to get those chemicals, you got to go to places all over the world to get them. So that's just one thing here. Obviously, coal, we need that for energy. And obviously steel, you need that for building all kinds of stuff, planes, jets, cars, buildings. We need U.S. steel to be real strong. This was an interesting article. Scammed out of her life savings, this 74-year-old admits to robbing a bank. So this poor woman got scammed out of her life savings. She had no money left, and basically in desperation tried to rob this bank. Now, I don't know that she got caught, but I think she turned herself in. And it's just a shame. It's kind of a wild case, but I felt pretty bad for this woman. I mean, she had a horrible thing happen to her, and it's terrible. These kind of things are terrible. It keeps you alert to fraud and what fraud can do to people, and why fraud is such a big thing, and why I talk about it a lot. So different scams out there that you have to be aware of. So. Okay, this I thought was funny. Jamie Dimon says that private credit is dangerous, but then he goes and invests $50 billion into it. So it's dangerous, but they're still going to get their piece of the action, right? I've been talking about private credit for months now, and I think private credit is a huge problem. And I will obviously have a lot more to say about this in the weeks and months that come, but I just thought it was ridiculous that Jamie Dimon, in one of his interviews in the last week, there's this whole diatribe about private credit's a problem, it's dangerous, and this and everything. So what are you guys doing, Jamie? Well, of course, we're investing $50 billion into it. Just unreal. Private markets giant Blue Owl pushes into 401ks. So firm is working with retirement service providers Voya to offer private assets and target date funds. So again, kind of what I reported on a few minutes ago about Donald Trump opening up retirement accounts to crypto, gold, private equity, and kind of this giant Blue Owl wants to basically line up for all this stuff to get ready for all this. Here's something that I am going to talk more about in the weeks and months ahead, and I might do an article on this, or not an article. I might do an episode on this, and that is healthcare. Our healthcare industry is in a bad way, and I don't think that most people realize how bad it is. In my area, I live in Pennsylvania, southeastern Pennsylvania, outside of Philadelphia. There's been a ton of mergers in the last couple of years, and these hospital systems, they think that economies of scale are what is going to save them, when it's not an economy of scale problem. It's an illegal immigrant problem, and it's a system problem. It's Obamacare. The disaster that is Obamacare has failed us. And what do I see here? Obamacare insurers seek double-digit premium hikes next year. Oh, really? Some enrollees could be hit with increases of more than 20%. Because of federal changes and higher health expenses. What is the key driver of those higher health expenses? I think we all know the answer to that, but I will let you dwell on that for a little bit. So, and I will come back. Like I said, I will be talking about these things more in future episodes, no doubt. Okay. So I want to wrap up now. I always end every episode with the story of the week and the quote of the week. So let me pull my stuff up here, and we will get into this. So, all right, my story of the week, I'm going to cover the last week. We did the London Metals Exchange, the LME. And so this week we're going to do the Federal Trade Commission, or the FTC. So the Federal Trade Commission is an independent agency of the U.S. government tasked with protecting consumers and ensuring a strong competitive market. Its principal purpose is to enforce non-criminal antitrust laws in the U.S., preventing and eliminating anti-competitive business practices, including coercive monopolies. The FTC also seeks to protect consumers from predatory or misleading business practices. The FTC may investigate a single company or an entire industry. If an FTC investigation reveals unlawful activities on the part of one or more companies within an industry, it can seek voluntary compliances via consent order, initiate federal litigation, or file an administrative complaint. Traditionally, such a complaint would be heard in front of an administrative law judge and may be appealed to the U.S. Court of Appeals and then the Supreme Court. So that is the Federal Trade Commission, or the FTC. Now, our quote of the week. Given the fundamental game-changing crypto legislation, the Genius Act that was passed this week that we started the program with, I thought this quote was very apropos. So here's our quote of the week. In times of change, learners inherit the earth, while the learned find themselves beautifully equipped to deal with a world that no longer exists. And that was from Eric Hoffer. So that is our quote of the week. And like I said, I thought that was very on point for this week. So, okay. Just a couple reminders. I would tell everybody, if you are listening to this on Apple Podcast or Spotify, I need some reviews. If you like what you're hearing, please leave me a review. Apple Podcast or Spotify, please leave me a review. I would love you for it. Tonight, I did my first multicast. I tried to basically, I was hoping to have this up on X, Getter, Rumble, and YouTube. So I'm hoping that those all went through fine. I'll be to check everything afterwards and see how this ran or how this looked. So again, I'm looking to add to the live stream and get this live stream out on multiple different platforms and channels moving forward. Maybe everybody might have noticed I had the new entry video tonight. You're going to be seeing a new background behind me here in a couple weeks as the strategy room begins to reshape itself and begins to form and have its own kind of vibe that's be a little bit different from the other videos on the channel. And I would remind everybody, episode 418, which was my interview with former Fed Governor Dr. Thomas Honig on his book, The Lords of Easy Money, which he was the principal character in. That has become my most watched interview to date. I have gotten a massive positive response back from everybody on that. People have absolutely loved the interview. So I would highly encourage you, if you haven't checked that interview out, please go check that out. If you haven't seen the Lords of Easy Money series, please go check it out. It will totally change your perspective on everything that's going on in the economy today. So with that, I will wrap up by saying, if you like the live stream, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments, as I always love getting back to everybody. And as always, please check out some of the other content on the channel. I thank everyone for listening. I hope everyone has a great weekend out there. I will be back next weekend, same time, same bat channel, 8 o'clock on YouTube, hopefully on X, Getter, and Rumble too on Saturday nights. And I will see everybody again real soon. Thanks a lot.